The Australian property market has just done something it has not done consistently since 2021. And if you play this wrong, it could cost you $95,420. Now, I know that's a very specific figure, but I've been investing now all over Australia for over 20 years. And over the last 9 years, I've helped over 500 people invest successfully in property. So I've seen firsthand how changes in the market like this can make people extremely wealthy, but cause others to miss out on tens of thousands of dollars and potentially even hundreds of thousands of dollars. That's why today I'm going to cover exactly what's happening in the property market and why, if you wait, it could cost you $100,000 or more, how to make the best of this opportunity that so many of us have, and how to avoid some of the biggest mistakes I'm seeing so many first-time investors make. Because unfortunately, I still see so many people buy into the so-called advice that now is not a good time to buy an investment property. After all, prices are expensive across Australia. The average house price in Australia has just reached over $1 million. There's economic uncertainty, especially what the US president is doing. So maybe you shouldn't buy. But when you look at the data based on what's happening in Australia, not buying could cost you a lot. Dark $95,420 property cloud looming for new buyers after RBA's interest cut silver lining. New research has revealed how much property prices spiked in the 12 months after the first interest rate cut from the Reserve Bank of Australia. Now remember, in this rate cutting cycle, our first rate cut was back in February. So how much could property prices rise as a result of this rate cutting cycle? Data from the RBA, Cotality and AMP detailed how the property market has reacted after the first rate cutting cycles in previous years. In the 12 months following a reduction in February 2001, there was a 16.2% jump in prices. After 18 months, prices had increased by 25.8%. That was the biggest increase in the data set that I'm about to show you. Even in the short term, values had increased by 3.6% 3 months after the rate cut. September 2008 and July 1996 also saw considerable one-year growth with a 4.9 and a 6.9% bump respectively. The median price over 12 months increased by 2.6% and 7.9% over 18 months. So that's 18 months after the first rate cut. On average, that's how much property prices rose. Now, according to the Domain House Price Report for June, Australia's median house price currently sits at $1.2 million. Cotality uses different data. It's saying that the average house price is just over $1 million. Either way, house prices are expensive in Australia. So if there was a 7.9% lift in that price using Domain's data, home buyers could be paying an extra $95,420 by July of next year. Now, you might be wondering, how can that be when prices are already so expensive? They're not affordable for so many people. How can property prices rise that much, even in the face of rate cuts? Will this time be different because prices are so high? Well, let's have a look at the data. Here we have data from Cotality looking at price rises as at the end of the 31st of July 2025. So when you look at the data, you can see that every single capital city has risen last month. And remember, last month, July, the RBA surprised most people by not cutting interest rates. Yet there is still a very strong expectation that interest rates will be cut in the future, and that's driving property prices to keep moving upwards. Sydney prices are up 0.6%, Melbourne 0.4%, but then look at Brisbane, Adelaide and Perth, 0.8%, 0.7%, 1%. Now, these are markets that have risen significantly over the last few years. And I see so many people say, oh, look how much those markets have risen. They have probably reached the peak. They are no longer good markets to buy in. But remember, when you're looking to invest in property, and I'll come back to this a bit later on, you want to be buying in markets where owner-occupiers are moving in. People are moving in to buy and live in properties in those areas. And it is very clear when we look at the data that our smaller capital cities, especially Brisbane, Adelaide, and Perth, while they have risen significantly, there is still stronger demand from owner-occupiers than available supply, which will keep driving prices up in those markets, along with now our bigger markets, namely Sydney and Melbourne. But here's a warning. You can't just go and buy blindly in those areas. You do need to do your due diligence, and I'll come back to how you can do that in just a moment. And if we go further down this table, we can see that Darwin, for example, is right now the strongest performing market, growing at 2.2% last month. Now, if we annualize that, so that means that performance continues over the next 12 months, the Darwin market could easily see price rises of 24% or higher, which is huge. So even though the data shows property prices are rising and the timing is perfect to get into the market as soon as you can afford, there are still other factors that could derail your property investment. So to make sure you don't go and inadvertently make a property mistake that could cost you tens of thousands of dollars, I've put together totally for free a property investing checklist based on my now 23 years of investing experience that you can download using the link in the description below. This checklist will help show you what to look for when looking to buy property, and more importantly, what to avoid. And it's yours totally for free, no obligation, when you click the link in the description below. Now, let me share a major mistake I'm seeing so many first-time investors make right now, and I don't want this to happen to you. Many people, they're seeing this kind of data. They're seeing the fact that prices are rising in multiple areas around Australia, and they're just buying blindly. It's almost as if they're throwing a rock, seeing where it lands, and just buying wherever it lands. They're not doing their proper research and due diligence. They seem to almost be of this belief that if they buy any property anywhere, they will make money. Unfortunately, that is not the case. We saw this back in 2021 when certain markets rose by 20% or more. Other markets barely moved, and some markets even fell. So you need to look at some key factors when buying property. And here are some of the big ones. The major one is look for demand from owner-occupiers. Are people who are moving into this area, are they buying properties and are they planning on living there long term? Are there amenities and aspects of this area that will attract more people to come into this area to buy and live long term? That's what you want to be looking at. You want to see if the demand from owner-occupiers is more than the supply. What about jobs growth? What about economic diversity? You do not want to go and buy, say, a cheap property for maybe $500,000 in maybe a small mining town somewhere. And then what happens if 2-3 years down the track, the mine closes and people are out of work? What are you going to do then? Your tenants won't be able to pay the rent. They're probably going to leave the area. You'll struggle to find a tenant, and worse, you may even struggle to sell your property, and meanwhile other areas will rise significantly. And if you're in your 40s or your 50s and you make that kind of mistake, how many years will it take you for you to come back from that, if at all? That's why I never ever recommend buying blindly. Do your research. Focus on the fundamentals that will give you, yes, good short-term growth, but also good long-term growth so that you can build true wealth through property that lasts. And of course, check the rental demand. Look, I don't care how much you might think an area is going to grow in value. If you can't get your property rented quickly, in my opinion, your entire investing strategy has gone pear-shaped. Your cash flow is going to suffer. You're going to have a lot more stress, and you're probably going to wonder, why did you even bother investing in the first place? So check the broader dynamics, check the fundamentals of the area before you then go and look at the actual property or properties that you might be considering. Now, of course, maybe you're wondering, how can this continue with prices continuing to rise and becoming less affordable for so many people, especially our next generation? How can prices keep rising? Well, the answer is that we just have so much more demand than supply. We are not building enough properties. In fact, if you look at construction levels today, they are lower than when our population was smaller and when our population wasn't growing as quickly. So that means we got more people, less properties being built. That's what's driving property prices up. And yes, that means that there will be a bigger wealth gap. That gap is widening. People who can afford property and buy properties in the right areas will get ahead faster than people who maybe either can't afford property or people who, worse, can afford property but choose to maybe stick their head in the sand and don't buy. They will be the ones who regret the most. And what I'm seeing right now is there are many families who understand the housing crisis and they are trying to protect their children by buying property for them. For example, here's an article that made the mainstream media about how a family bought a property for their 4-year-old. I recently met a fairly wealthy family who said that they just bought a property worth $3 million for one of their children to own in the future. When I said, why are you buying property at $3 million? They said that they want to buy property for their kids in really A-grade blue chip locations. And they felt that if they waited for their kids to be able to be in a position where they're old enough to buy property like that, it could easily be worth $5, $6, $7 million. So families who are getting into the market to either get themselves into a position where they can retire wealthy and or to help their children. What that means is the housing crisis is only going to get worse. And so if you are someone who can afford to buy property and you choose not to, the cost of that is going to be huge. But at the same time, you can't just buy blindly. So look, if you want help to just make this happen because you don't want to go and make a mistake or you don't have the time to do it all, check out the link in the description below to book totally for free a no obligation consult with a member of my team where we can walk you through more about what we do, what your goals are, and if we can help you build a property portfolio without the stress. And so yes, I believe there could be a major property mega boom brewing. There are so many factors pointing towards prices rising. I haven't even spoken about how the government first home buyer initiatives that are coming in from January 1 will again stimulate more demand, have more people jumping into the market. The fact is there is so much happening to increase demand, but supply is just falling away. So buying as soon as you can is important. The stakes have never been higher, but that's just the first step. And it means nothing if you don't know how to truly build a property portfolio. So if that's what you'd like to do, whether it's for yourselves, for your retirement, for your children, then check out this next video where I walk you through step by step how to build a property portfolio without stressing your cash flow and without affecting your lifestyle. Check out that video now.